Right, traders, there is one thing that I want to make sense of tonight because the Federal Reserve, as we know, they're very much in focus right now. The United States Central Bank just got the exact type of economic signal it really doesn't want. Now, the purpose of these videos, by the way, welcome if you are new to this channel. KenMacro channel is very much new. Obviously, we're building a space for traders to actually and investors to actually understand economics, macroeconomics, fundamentals, and how they translate on the charts and how important they are of driving the assets that we are trading. They are driving the prices into certain areas of liquidity. I'm a macro and liquidity trader, driving the price into those key areas of liquidity. So it's very important that we understand and we're in sync with how the important and influential these macroeconomics are. Now, look, Americans in the United States are becoming less confident about the US economy, while at the same time, we have inflation in the United States going up. You can see here the dollar chart, which we're going to get onto in a moment. This is the dollar index. Now, this is a horrible combination where Americans aren't really confident, growth is slowing down, but prices are everyday costs, goods and services are remaining extremely sticky. They're high. Okay, so imagine that growth slowing down, but sticky prices. And basically, what we're going to see tomorrow is a test of both sides of that problem at the exact same time. So we're going to get an understanding of US growth, which we're going to go into. We're going to get an understanding of US inflation. There's a number that's coming out, which is the Fed's, the Central Bank of the United States, their preferred measurement of inflation. And whatever comes out could obviously change what happens next. Obviously, in the dollar, the chart that we've got up here, gold, bonds. I'm sure you've seen all the chaos that's happening in a moment in the bond market, which we'll talk about. Obviously, all going into is a very, very key, well, not decision, it's a very key event happening this Friday at Jackson Hole, this Jackson Hole summit, where annually the Federal Reserve will meet. Now, at Jackson Hole, this is going to be the new governor, Kevin Warsh, his first actual Jackson Hole as the chair. Now, let me show you why. Let's go over to, let me just quickly look at the dollar, right? At the moment, the dollar, we're seeing the dollar downside, lower highs, lower lows. Structure is very much bearish. We had this wave of downside momentum because the Federal Reserve had sat on the fence, right? Kevin Warsh came out guns blazing, flexing his muscles, saying he's going to do this, that, and the other. He's not going to spoon feed the markets, right? He came in really hard and then he went limp, in the last decision where he sat on the fence. They didn't commit to further rate hikes. Then we had the intervention with US and also Japan intervening, selling dollars and buying JPY. So that resulted in quite a substantial amount of dollar downside. All this downside here, throw into the mix the fiscal sustainability in the United States, throw into the mix the geopolitical tensions and everything else and the stagflation situation, which we're going to talk about. Now, let me just show you this. So this came out today. And by the way, the purpose of these videos, and I'm going to try and do them on a daily basis, it's just me breaking things down as well. So just my sort of thought process is observing everything. I like to do this at the end of the day. I also do it at the start of my trading day as well, especially when there's big macro events going on. And especially right now, it's very, very delicate. So excuse that I can just see I'm lagging out a little bit. My computer can't catch up with the heat of the value that we're going to be dropping. So if we start off here, US consumer confidence slipped to a 7-month low as job and business fears grew. Now, as we know, we are seeing a slowdown in the jobs market in the United States. We're seeing less jobs actually being removed, jobs are being lost, wages are coming down, which is a really not nice situation to be in. This actual figure came in at its lowest, as I say, lowest reading in 7 months, coming in at what's the figure here, 89.4, as households grew more pessimistic about labor market and business conditions over the next 6 months. So it's very important that if a consumer's not, you have to understand, if a consumer's not confident, what is a consumer less likely to do? They're less likely to want to go out and spend their money. They're less likely to want to go out and, uh, do this, do that, leisure goods sort of things, so on and so forth. So, and businesses, they will tighten up if they're not confident about the economic outlook and how things are in the economy. They're going to be reluctant to want to hire and spend and boost out business infrastructure. You see how that works. So this came out today. It dropped. It's the lowest level since January. But what I actually care more about is what's underneath it, right? People are becoming more pessimistic about business conditions and jobs over the next 6 months. Okay. Is not looking good at all. Right. This is not looking good. This decline, drop in the index, which measures consumers' 6 month outlook for income, businesses, and labor market conditions. So the gauge falling quite substantially there as people and businesses are more pessimistic. So that's your growth concern, right? This is our growth concern. And at the same time, the expectation, if it's in here, it should be somewhere, but the expectation for inflation, right, over the next year actually went up as well. It went up from 5.6% to 5.8. I'm sure it's in here. I was reading the full report. Yeah, here you go. Sorry, no, that's the wrong one. Let me just search for that. I'm sure it's in there. There we go. So households anticipated inflation would run at 5.8% over the coming year from 5.6% the prior month. So their confidence is coming down, growth is coming down, but then they're seeing a higher inflation, which is a nasty, as I say, this is a nasty combination. Now, that's a survey. All right. That is an actual inflation. But think about the message really, really importantly, as I've just said. I am becoming less confident about the economy. And still, I'm very much worried that things are going to get more expensive, right? Usually you think in these sort of times, potentially a central bank could come in, people are pessimistic, businesses are pessimistic, growth is slowing down. Let's come in and conduct some sort of action to try and help ease these fears and try and cushion the blow for this potential downturn in the economy. But this is obviously a completely different thing. So this is almost the exact problem right now the Fed doesn't want. In some sense, you've heard me say it before, the Fed's hands are tied. Think about it, the Fed, like somebody standing in, let's say, a kitchen with two fires going on right now. Okay. One is, let's say, is inflation. The other is a slowing economy. And they've basically got one bucket, interest rates. That's your first moment, right? Okay. Which we're going to talk about. Now, let's go back over to the dollar index. Okay. Now, why should you give a shit if you trade currencies about what I've just said? Because the dollar doesn't simply just trade whether America is doing well or badly. It trades what all this changes with regards to interest rates, right? This is obviously the part that a lot of people constantly miss. Bad data comes out, you don't automatically just sell the US dollar. You've heard me say this before. I dropped a video on my channel, Real Ken Chigbo, just explaining this. Hot inflation comes out, you don't automatically buy the dollar, okay? As we've seen on numerous occasions. You ask, did this change what people think, what markets think the Fed are going to do? Because that's what it's all built up about, is about market expectations. Because if expectation change, right, of what people anticipate the Fed are going to do next in terms of their next course of action, right, money moves. It always moves before the Fed ever touches actual interest rates. It's very, very important to note that, okay? Very important to note that. So data, expectations, money, price. The candle is the very last, okay? Is the very last. And if this is part of the trading for you that has always felt like a fucking black magic to you, right? This is exactly the bit that I want you paying attention to through these videos. You don't need to be a freaking economist. You've heard me say that before. All you need to do is just understand this chain that I've explained, right? It's very, very important. Data, okay, what is data doing? Then market expectations. Then we're looking at obviously money, where the money's going to flow based on expectations. Then we're looking at price. As I say, this candle situation is large. You're understanding all that chain and what's underneath to then drive what's happening here on the charts, right? All right, now what I want to do is I want to pull up yields. Okay, I'm sure you've heard me talk about yields before in the past. Sorry, this is not the yield chart. Let's bring up yields here. Okay, so if you look on TradingView, you can bring these all up yourselves. You've got US 10-year, 20-year, 30-year. Obviously, you've got 2-year, 5-year, 10-year, 20-year, 30-year. Now, obviously, 2 years are shorter dated bonds, 30 years you're longer dated. So, for example, if you're to invest in the United States over a 30-year period, this is the yield you're going to get, right? And so on and so forth. Obviously, for holding risk longer, right? For holding bonds longer, you should get greater reward because there's greater potential risk that anything could happen in that whole 30-year period. Does that make sense? Now, okay, if we look at bonds, because this is obviously going to give us another clue. This is obviously the 2 year. as I've explained. It's very simple. The 2 year cares a lot about what people think the Fed's going to be doing over the next few years, because obviously this is over a short time horizon. Then you've obviously got your 10s and your 20s and your 30s. Now, as you move further out, we start caring much more about things such as long-term inflation trends. Where are the long-term inflation trends? Looking at government borrowing, we're looking at debt, we're looking at risk. So think about it like this. What return investors need in order to lend American money for decades, right? So effectively, when you are a investor into US government bonds, yes, you're getting a return on your investment, but you're also lending the US economy. You're lending their money, because then they use your money, just like banks do. They use your money to obviously boost out the economy, boost out infrastructure, so on and so forth, operationally. Your money is a loan to them. All right. And for that, they pay you interest, they pay you a yield. Now, if we look, we've obviously been rising drastically. This is where people have been panicking. When you look across the board, yields have been largely on a rise in expectation of higher inflation, but also higher risk. If there's higher risk associated to the US economy to invest in what's supposed to be a fixed income, a safe haven, if there's higher risk associated to that, comes higher yield. As we've been explaining, there's a lot of worries at the moment around the US economy. Now, remember, this is really, really key. When you look at the 30 years, so if we just pull this up here, was it last week we were above 5.3%? So we are drastically rising there. And this, if you have a look on the chart here, when was this? This is the highest levels that we've seen since, let's go all the way back. Sorry, we're going to have to go on the monthly a moment. Stay with me. It's really, really important. These are the highest levels since 2007. So we had the US 30 year above 5.3%, the highest levels since 2007, nearly 20-year highs. Yeah, nearly 20-year highs. And it's where I keep saying, don't just look at a yield going up and say that's dollar bullish, right? Ask why. Why are yields rising at the moment? Like, why are they rising so drastically? If America is booming and yields are rising, fine, that's lovely. If investors are saying, I'm worried about inflation, I'm worried about debt, I'm worried about risk, so pay me more to hold this shit for 30 years, that's a completely different message. Now, let's get on to where things got a little bit weird last week. Now, if you look at this is the government, the US Treasury, the US Department of Treasury, right? They announced last week, you may have seen this and thought, what does this even mean? But they announced increased sizes of normal. God, sorry, guys. It's late at night, hence why I'm effing up a little bit. Treasuries announced increase, because I don't usually, I mean, I do, to be fair, as part of my process is what I do, but I don't always talk out loud. Obviously, I'm talking out loud here for you guys tonight. Treasury announces increased size of nominal long-end liquidity support buybacks beginning September 9th. Okay, so they announced that they're at least doubling the sum of their long end bond buyback. So 2 billion per operation becomes at least 4 billion. Now that making it stupidly simple. What does this mean? If loads of people are effectively selling something, right? What helps the price? A bigger buyer. The Treasury is basically saying we're preparing to buy more of these long dated, these longer term bonds. More demand, obviously, supports bond prices, right? Because obviously you saw that panic where bond prices were coming down, the yields were rising, because obviously people were like, I don't want them, I don't want to touch them. Like if you're going to make me, if I'm going to invest in them, I need a higher yield, right? I need a higher return because it's risky. So remember, when the bond price is up, yields come down, and obviously opposite directions. When bond prices are down, yields go up, right? That's it. Then, and again, this isn't a form of quantitative easing where, we get the Federal Reserve printing money and they're pumping the economy with money. This isn't the Fed printing a load of money, to make that very clear. This is a different institution. This is the US Department of Treasury, right, with the government. And this is the Treasury. It says them providing liquidity to the market, right? So this is the Treasury providing liquidity to the market. This isn't the Federal Reserve printing money. But then you have to think, why now? Why now? Okay, then you had this guy coming out, Stanley Druckenmiller. And he, for anyone that doesn't know, he's a billionaire, massive billionaire. He's very much a philanthropist. He's very big on Macro. He's actually a former hedge fund manager. So this guy has a view worth listening to. And he was basically saying that he doesn't like what the Treasury announced. He thinks that it's obviously going to be a big mistake. His argument is that if yields are rising, if yields are high, because you've got a proper fiscal problem, buying more bonds doesn't actually solve that underlying problem, which makes sense. You're treating the market pressure. You're not obviously solving why investors are actually demanding that higher yield in the first place, right? Which is what we've been speaking about. So he described this in large buybacks as a mistake and argued that lasting relief requires them dealing with the underlying primary deficit rather than leaning on liquidity tools. So imagine, for example, let's just put this an idea of this. So imagine you've got $100,000, right, of debt, and I'm struggling with the payment. Moving some money around might help this month's payment, right? But it doesn't magically remove that 100K of debt. That's basically the argument. And this is why this has become bigger than some boring freaking Treasury announcement that we saw here that you were probably all scratching your heads about. It's starting a conversation about confidence. Remember, at the start of this, we spoke about confidence from a consumer and a business perspective, right? And this now leads beautifully into gold. Okay. Now, okay, this keeps populating with the wrong chart because I've got multiple trading view charts up, but here we go. Gold price has obviously been ripping it to the upside. Let's just look on a naked chart a moment. We've been ripping it to the upside with everything that we've discussed that's been going on. These are reasons why gold is pushing to the upside. Now, guys, obviously where we gotten up to today in terms of at the time recording, we jumped to highs here at just shy of the psychological 4,700 mark, right? Knocking on the next major area of liquidity that I've been calling, right? I've called this for a while, and that we're going to reach, be magnetized into, drawn into the next area of liquidity because of this macro regime that we're talking about in towards sort of 4,740. This is basically the zone I've got marked up here, right? Now, I'm not sitting here saying, obviously, gold is bullish, buy gold. Okay. I'm not giving you financial advice. I'm just talking you through everything because obviously tomorrow could completely change the conversation. As we know, macros, people always messaging me like, oh, Ken, this happened. Yeah, macros change, my man. That's why macros are the driver. They change. When they change, they can force breakout of structures. They can change, obviously, trends. The macro regimes change. That's why you have to keep your finger on the pulse in it. Now, look, why is gold here? Right? We've had the weaker, broader dollar behavior, which I've explained. Yields have actually been pulling back in the last couple of days, as we just saw there. If you look here, yields coming down now. Okay, we've obviously got this geopolitical risk still with US and Iran. What a mess, right? The Strait of Hormuz still freaking closed. Obviously, US announced these D-Day economic sanctions, and what was it? Iran threatened retaliation by striking some US bases, US companies across the Middle East. And now you've obviously got the bigger questions that are coming into play, which is US debt and policy. All of that has helped gold. So you see, it's a serious stack. It's a serious macro stack supporting the precious metal to the upside, right? So yeah, but now we're about to get obviously the Fed's favorite inflation measure. So this is where this potential view gets tested. So let's pull this up here. So this is the BEA.gov website. You can obviously see, I mean, some people, I mean, you guys will use, but obviously this is the release schedule via the official website of the US government. But obviously we could pull this up and have a look on Forex Factory. I'm sure a lot of you will be using forexfactory.com or Trading Economics. But here, this is obviously the core PCE. This is due out at 1:30 London time, 8:30 Eastern. And this is why Wednesday is fucking interesting, excuse my French. And it's exactly at the same time tomorrow that we get GDP data. So we've got the Fed's preferred measure of inflation and we've got prelim GDP quarter on quarter. So think about what we were just talking about. The Fed has got obviously two problems: growth, GDP, inflation, PCE, the Fed's preferred measure of inflation. So tomorrow we'll get a read basically on both of them. Now, the BEA obviously confirms that we've also got, where is it? We've got personal income and outlays, which is definitely going to be of interest. And obviously the second estimate of GDP is second estimate of GDP. So we've got that. So yeah, if we have a look at the prior numbers, if you look at GDP, generally speaking, we have been cooling If you have a look here, the last sort of few quarter-on-quarter readings have been cooling, which is obviously a sign of economic slowdown, understandably. If we look at the Fed's preferred measure of inflation, PCE, this is obviously on a month-for-month, but when you look on the annualized is sticky. The core number of the annualized at 3.3%. Bear in mind, this is well above the Fed and obviously other major central banks. They want inflation down at around 2%. That's where they see stable prices. So the realistic tomorrow, the simple scenario is, so imagine tomorrow we get growth data, which these numbers, I wouldn't be surprised they get revised lower, get revised weaker. And then we get this inflation number, which is actually expected on a month for month, and I'm sure in the year on year as well. I haven't pulled up the expectations here, but are expected when we get hotter inflation. What the fuck does the Fed do with that? What does the Fed do with that? That's exactly the trap, right? So it's very, very interesting. Now, let's make tomorrow stupidly simple. All right, let's make this stupidly simple. By the way, this, as I say, for your reference, you can pull these up, the official releases when they drop. You've got all those here, so you can pull those up yourselves. But let's make this stupidly simple tomorrow. Scenario one. This figure, inflation, comes in hot. Okay, hotter inflation. We get growth stronger. That makes a Fed hike, another Fed hike, yes, easier to potentially justify. Remember before, a few weeks ago, markets were largely ramping up their expectations for rate hikes. Yields will probably go higher on that. Dollar should like that. Gold will potentially struggle on that scenario. Scenario two, the inflation figure, so this comes down. So softer inflation. GDP comes down. Growth weaker. What does that mean? The Fed is less likely to need to hike. Shorter end yields, fives, your twos, potentially come lower. Dollar pressure. Gold loves that much more. Then you have scenario three. Say we have stronger growth, softer inflation. That's basically a nice outcome, to be honest. The economy holding up, inflation easing, markets can probably breathe. Scenario four, a very, very nasty one. Okay, a very nasty one. So we'll have growth weaker, inflation hotter, higher. Now you've got exactly what today's confidence survey was hinting about, right? When we looked at this at the very beginning. US consumer confidence and business confidence is largely hit, okay, because of the economic outlook, the slowdown, they're seeing higher inflation. That's exactly that, scenario four, okay? So that's the one I think markets would find most interesting, and that's what I would be most interested in. Let's go over to our next tab. Okay, for anyone that doesn't know, this is obviously no, it's not obvious if you've not seen it, Ken, guys. This is the CMEgroup.com. If you go to CMEgroup.com, you'll have the Fed Watch tool, which if you watch my content, you'll see me cover this a lot. Stay up to date with the latest probabilities of FOMC rate moves. So this gives us the likelihood of what markets are pricing in by the futures markets. What are they pricing in when it comes to rate hike probabilities, okay? So let's read the live numbers right now. September, we're sitting at 38.4% probability of a hike. Markets are largely expecting unchanged. With regards to rates, October, it's 50-50. It's a coin flip. And then December, it is as a 68.1%. It's funny because this was 90-something% just like 2-3 weeks ago. So look, I'm not using this because obviously the CME has some freaking crystal ball. I'm using this and I'm referring back to what I said at the beginning of this video, right? About markets pricing. I'm using it because I'm showing you what these markets are, what traders are pricing in. And right now they've priced out a lot of that risk of a potential hike in September, which was there. So that's really, really key. That's important because going into tomorrow's PCE, it isn't entering neutral market. The market has an opinion already right now. They have an opinion. So if inflation surprises hot, what do you think is going to happen? Some of this rate hike probability for September, right, could come straight back. This could start rising back up to sort of 40 something, maybe close to 50%. That's where I watch the two-year yield. Then the dollar then gold. Okay. So the next one, the big one. Thursday, we got Kevin Warsh. Okay. Federal Reserve Chairman. As I say, this is his first Jackson Hole as the Fed chair. And again, don't sit there waiting for Twitter to tell you hawkish, dovish. Forget that. I'm asking one question. Which problem, and let's see, I'm hoping my man doesn't sit on the fence, but which problem does he sound more scared of? Is he more scared of inflation or growth? Walsh is scheduled to deliver the keynote at 3 p.m. London time. That's what? Is that 10 Eastern? It's about 10 Eastern. Yeah, 10 Eastern time. So if PCE data, as I said, on scheduled tomorrow, comes in hot, he spends Friday smashing inflation. Different, obviously, dollar story, right? Which we've gone over. If growth comes out weak, right, we see those revisions lower. He starts spending more time worrying about the growth, the economy, right? He in his last rate decision, he was talking about economic activity still expanding at a solid pace. So that wording could change, which would, reading in between the lines, would mean he's concerned about growth. Okay, so tomorrow gives us evidence. Friday gives us, obviously, the Fed's reaction to the evidence. All right. So ideally, as I say, what you want to be keeping an eye on is the dollar index. Obviously, all of this, gold, stocks, it's all key, all ties in. So the dollar index, the 2-year, the yields, all yields, just bring up yields, 2-year, 30-year, and then obviously gold, right? Those what you want to be, that's pretty much my dashboard, right? That's going to be my dashboard heading into all this. So dollar, bond yields, gold. I don't need 50 freaking charts. Tomorrow's the first thing that I'm watching after the PCE isn't even the headline. Okay. I want to see what does this 2-year yield do? Okay. What does the dollar do? Right. As we had. What does gold do? And there's one relationship that I'm particularly interested in, right? If inflation comes in hot, yields jump, and the dollar still can't properly rally, then we've got a much bigger conversation. Because now, even the thing that should be supporting the dollar, right? If yields are rising, typically speaking, as we mentioned before, if yields are rising when the economy's strong and we're in a economically sound place, there isn't any worries, the money's going to fly in, right? People are going to want some of that yield. And obviously, to invest in that bond, we need what? Dollars. So it's not supporting that right now. It's not supporting that. And if you're technically decent, but all this stuff before the chart is the bit that you've never properly understood, that's literally what I work on with traders, guys. And I've been doing this for years. How to build a freaking macro view, how to understand what the market's pricing, how to understand this chain, then how to make this information onto the chart without turning yourself into an economist. That's key. Now, I've got a few spaces open right now to work with me privately. If you're serious and this is genuinely a piece that you're missing, DM me macro on Instagram or on X, preferably Instagram, much more active on there. Otherwise, tomorrow after the PCE number, we're going to find out whether this story just got stronger or whether the market completely changed it for us. Thank you for watching, and I'm going to catch you in the next one.